In the world of global commerce, money speaks many languages. But when it comes to reporting that money to the public, there are two dominant grammars used by accountants worldwide: GAAP and IFRS. If you're an investor in New York, you look at GAAP. If you are a CEO in Paris or Tokyo, you likely report in IFRS. While they both aim for transparency and accuracy, the path they take to get there is fundamentally different. Today, we're breaking down the great divide between U.S. standards and the international rules of the road. First, let's look at the authors of these rulebooks. GAAP, Generally Accepted Accounting Principles, is primarily used in the United States. It is governed by the FASB, the Financial Accounting Standards Board, and overseen by the SEC. IFRS, International Financial Reporting Standards, is issued by the IASB, the International Accounting Standards Board. It is the standard in 140 countries, including the European Union, Australia, and Canada. Why does this matter? Because a company's profit can actually change depending on which book they use to count it. This is the most significant difference between the two. GAAP is rules-based. It's a massive, detailed volume that tries to provide a specific instruction for every possible scenario. It's like a cookbook that tells you exactly how many grains of salt to add. IFRS is principles-based. Instead of 1,000 specific rules, it provides a set of core principles and asks accountants to use their professional judgment to follow the spirit of the law. It's like a recipe that says, "season to taste." While IFRS is more flexible, GAAP is often seen as more rigid, which can actually make it harder for companies to game the system by finding loopholes in the wording of a rule.
One of the biggest technical clashes is how we value inventory. GAAP allows a method called LIFO, last in, first out. This assumes that the last items you bought, usually the most expensive due to inflation, are the first ones you sold. This lowers reported profit and, importantly, lowers tax bills. IFRS strictly bans LIFO. It only allows FIFO, first in, first out, or weighted average. Because LIFO is banned under IFRS, an American company moving to international standards could suddenly find itself paying much higher taxes because its profit appears higher on paper. Sometimes, an asset, like a building or a machine, loses value. Accountants write it down to reflect that loss. Under GAAP, once you write an asset down, it stays down. You cannot unring that bell, even if the asset's value recovers later. Under IFRS, if the value of that asset goes back up, you can reverse the write-down. This makes IFRS more real-time in its valuation, but critics argue it allows companies to fluctuate their earnings too much by adjusting asset values back and forth. How do we record the money spent on a new invention? GAAP requires that almost all research and development, or R&D, costs be treated as an expense. This means they are deducted from profit immediately. IFRS is more nuanced. It says research is an expense, but development costs can be capitalized, which means they are treated as an asset on the balance sheet and spread out over time. As a result, a tech company reporting under IFRS often looks wealthier in terms of assets than the same company would look under GAAP. Even the way the sheets are formatted differs. GAAP usually lists assets in order of liquidity, meaning the stuff that can be turned into cash fastest, like cash and accounts receivable, comes first. IFRS often does the opposite, listing non-current assets, like property and equipment, first. While it's a cosmetic difference, it requires investors to be nimble when switching between a US and a European financial statement. What happens when something truly strange occurs, like a massive natural disaster or a one-time legal settlement? GAAP used to allow these to be labeled as extraordinary items on the income statement to show they aren't part of normal business. Though GAAP has moved away from this recently, it still maintains more categories for unusual items. IFRS simply does not use the term extraordinary items. Everything is just part of the profit and loss, though it can be disclosed in the footnotes. For decades, the FASB and IASB have been working on convergence, the idea that one day there will be a single global accounting language. They have successfully merged rules on things like revenue recognition and leases. However, full merging is unlikely. The U.S. is hesitant to give up control to an international body, and the tax implications of LIFO, among other things, are too massive for the U.S. government to ignore. In a globalized world, you are likely to invest in or work for companies that cross these borders. If you don't understand the difference between GAAP and IFRS, you might misread a company's health. One isn't necessarily better than the other. GAAP offers more protection through strict rules. IFRS offers more flexibility through professional judgment, but both are essential to keeping the gears of global finance turning.